Hi everyone, a lot of talk lately about silver breaking out, gold holding firm, banks looking fragile, and whether this whole paper system is starting to send a warning that most people are missing. So in this video, we're going to separate the signal from the noise, and you are going to walk away feeling a lot smarter and more confident about what is really happening underneath the surface. Today is Tuesday, May 12th, New York time. Comment below what day and date you are watching from, because it always tells us how quickly this story is moving through the community. And before we go deeper, support this channel by subscribing, and if you value this content, comment John A.G. Best below. Simple as that. It helps this work reach the people who actually care about real money, real assets, and real risk. So here's the big question. Is silver just having another exciting rally, or is this move telling us something much larger about trust, debt, and the financial system itself? On the surface, the story looks pretty easy. Silver sold off hard, chopped around, frustrated almost everybody, and then started pushing higher again. That is what everyone sees. But the part that matters is not just the price move. The part that matters is what happened around the price move. Because silver did not start moving in a calm world. It started moving while government debt was still enormous, interest costs were still climbing, bond markets were still nervous, and investors were still trying to figure out whether central banks really have control anymore. That is the first clue. Now, technically, silver had been acting like a market that went through a violent shakeout, not like a dead asset. There is a difference. In a bear market, rallies usually fail quickly. In a bull market, corrections scare people, reset expectations, and then the strongest assets begin climbing again when the crowd is tired of watching them. And that is why this breakout matters. It is not because one green day proves everything. It does not. One candle does not make a monetary crisis. But when a market that has been compressed starts pushing through resistance while macro stress remains alive, you have to pay attention. Recently published numbers still point to a silver market that is tight. Demand is not perfect across every category, and we need to be honest about that. Industrial use is expected to soften in some areas, especially where manufacturers are finding ways to use less silver. But investment demand is expected to recover strongly. Mine supply is only expected to rise slightly, and the overall market is still being discussed as running a deficit again. That combination is what makes silver so interesting. It is part industrial metal, part monetary metal, and part fear gauge. It can respond to factories, solar panels, electronics, artificial intelligence infrastructure, automobiles, investors, inflation, currency weakness, and panic. That is a weird mix. And weird mixes can create violent moves. But here is where people make the first mistake. They hear deficit and immediately think, okay, shortage tomorrow, price explosion next week, system failure right after that. Slow down. A deficit means demand is running above available supply in the measured market. It does not mean every dealer shelf goes empty instantly. It does not mean no one can find ounces. Markets adjust through price, recycling, substitution, delays, and inventory drawdowns. So yes, the silver story is bullish, but it is not magic. That distinction matters because we are not here to chant slogans. We are here to understand the mechanism, and the mechanism is this. Silver does not need every bullish argument to be perfect. It only needs enough demand to keep meeting a supply base that cannot respond quickly. Mines do not appear overnight. Refining capacity does not expand by wishing. Old coinage does not get minted again. And when investment demand wakes up at the same time industrial users still need material, the market can get uncomfortable very fast. That brings us to the old coins. Pre-1965 United States silver dimes, quarters, and half dollars are not exciting to look at. Most of them are worn. Some look like they have been through 10 lifetimes. But that is exactly why people like them. They are recognizable, fractional, familiar, and difficult to fake in any practical way. A shiny bar can be beautiful, but a small old silver dime has a different job. It is not trying to impress anyone. It is trying to finish a transaction, and that is the key. If you ever needed to use silver in a difficult environment, a large coin or bar creates a problem. What happens if the purchase is small? What happens if the seller has no change? Suddenly, the transaction is no longer settled. Now somebody owes somebody something. Congratulations, you just recreated credit. A small silver coin avoids that. It closes the loop. Now, does that mean America is going back to paying for eggs with old dimes next month? No, we do not need to exaggerate. But preparedness is not about predicting the exact disaster. It is about understanding which tools work in which environment. Large bars are good for storing weight. Smaller coins are good for optionality. And optionality is one of the most underrated forms of wealth. Here is the part people miss. A lot of old fractional silver is being sold by longtime holders. Dealers buy it, refiners process it. Once it melts, it may still be silver, but it is no longer old United States coinage. That form is gone. So even if total silver ounces remain in the system, the practical coin form can shrink. That is why cheap junk silver can be a strange opportunity. It can look boring when it is available, and then suddenly become the thing everyone wants when conditions change. We have seen versions of that before. During stressful periods, the issue was not only price, it was availability, shipping, staffing, premiums, and dealer capacity. People always imagine they will buy when it is obvious. But by the time it is obvious, the easy window is usually closed. And this applies to selling too. A lot of investors say, I will ride silver higher and then swap into gold at the perfect ratio. Fine. That might be a smart strategy. But taxes, premiums, bid-ask spreads, shipping delays, and dealer capacity all matter. If everyone tries to make the same trade at the same time, the trade becomes crowded before you even pick up the phone. So the real question is not what is the perfect price. The real question is, can you execute when the moment arrives? That is why storage matters. Gold is value dense. A serious amount of wealth can fit in a small space. Silver is different. Silver has weight. Silver has bulk. Silver has boxes, bags, shipping labels, insurance questions, and back pain. So personal possession makes sense for some of it. Vault storage can make sense for some of it. A hybrid approach can make sense too. The right answer depends on purpose. Emergency access is one purpose. Easy liquidation is another. Privacy is another. Safety is another. Anyone who says there is only one answer is probably skipping the hard part. Now let's widen the lens because silver is not the only story. The bigger issue is counterparty risk. A bank balance is not the same thing as cash in your hand. A brokerage statement is not the same thing as a certificate or direct registration. A money market fund can feel like cash, but it is still a product with rules, holdings, liquidity policies, and stress behavior. That does not mean everything is unsafe. It means you should know what kind of claim you actually own. Direct registration exists because some investors want their securities recorded directly in their own name on issuer or transfer agent books. That is a different setup from simply holding everything through a broker and street name. It may reduce one type of custody concern, but it can also reduce convenience. Again, trade-offs. Brokerage protection also has limits. Investor protection is generally designed to help if securities are missing after a brokerage failure. It is not designed to protect you because your investment went down or because you bought something that became worthless. That is a very different kind of protection. Money market funds are another example. People often treat them like cash because they feel like cash, but they are not exactly the same thing. They hold instruments. They manage liquidity. They respond to redemption pressure. And after recent rule changes, some of the old gate mechanics were changed, but liquidity fees and stress dynamics still matter. So the better way to say it is not money funds are bad. The better way to say it is know what you own and know how it behaves when everyone wants out. This is not fear. This is due diligence. Now the debt side is where the whole conversation gets heavier. The United States is carrying debt at levels that force the market to care about interest costs. Budget projections show interest payments taking a growing share of the economy over the next decade, and public debt moving higher as a share of national output. Meanwhile, the Treasury market itself is massive, with outstanding securities in the tens of trillions. So when yields move, it is not just a line on a chart. It affects mortgages, banks, pensions, insurance companies, corporate borrowing, government budgets, and the valuation of almost every financial asset. That is why the next easing cycle matters so much. Normally, if central banks cut or ease, people expect bond yields to calm down. But if yields rise while policymakers are trying to loosen conditions, that sends a different message. It says the market may be worried about inflation, currency risk, supply, or confidence itself. And if confidence becomes the issue, gold and silver start getting a very different kind of bid. But here is the counterpoint, and we need to say it clearly. The system is not automatically collapsing just because silver is strong. Household and business debt measures have actually looked more moderate in some recent stability reports. And investment-grade corporate credit has not been flashing the same kind of immediate panic that doom narratives often imply. So the honest view is not everything is fine, and it is not everything ends tomorrow. The honest view is that the system has strong parts and weak parts. The weak parts show up when liquidity gets tight, confidence gets questioned, and too many people try to leave the same theater at once. That is the risk. Not one headline. Not one chart. The crowd at the exit? If you're successful, share your success story in the comments so others can stay motivated. People need examples of discipline, not just predictions of disaster. There is also a global angle here that people underestimate. Debt is not just an American story. Around the world, borrowing has climbed into numbers so large that they almost stop feeling real. Governments need to roll old debt, issue new debt, fund promises, defend currencies, and keep investors confident at the same time. That is a difficult balancing act even in calm conditions. In a world with energy shocks, wars, elections, trade friction, and stubborn inflation, it gets harder. And silver sits right in the middle of that uncertainty. If growth stays strong, industrial users still need metal for electronics, vehicles, energy systems, sensors, switches, and the hardware behind the digital economy. If growth slows and investors get nervous, the monetary side of silver can wake up. If inflation stays sticky, people look for hard assets. If rates stay high, debt stress gets worse. If rates fall because policymakers are worried, people ask what they are worried about. That is the trap. The metal can benefit from more than one story. But again, it is not one-way traffic. Solar manufacturers have been learning how to use less silver per panel. Some jewelry and silverware demand weakens when prices rise too fast. High prices invite recycling. And if a global slowdown hits hard enough, industrial demand can disappoint. So the bullish case needs humility. The market can be right for the wrong reason, and it can punish people who are right too early. This is why I do not like dramatic all-or-nothing thinking. The best investors do not need every prediction to land perfectly. They build a position that survives uncertainty. They understand custody. They understand liquidity. They understand why fractional silver is different from large bars, why gold is different from silver, and why a brokerage account is different from direct ownership. That kind of thinking is not as exciting as a crash prediction, but it is far more useful. And that is why patience matters. A breakout deserves attention, but confirmation deserves respect. The people who survive big moves are usually not the loudest people in the room. They are the ones who planned before the room got loud. So what should we actually watch from here? Watch whether silver can hold its breakout instead of giving it back immediately. Watch whether investment demand continues to recover. Watch whether premiums on smaller physical products start moving differently from large bars. Watch whether bond yields ignore central bank comfort talk. Watch whether money keeps drifting from paper promises toward things that do not require someone else to perform. And most importantly, watch your own assumptions. If your plan depends on brokers working perfectly, banks staying calm, dealers never getting backed up, shipping always being easy, and markets always being open, then your plan is not really tested. It is just comfortable. The goal is not to root for collapse. A broken market is not a victory. If price discovery breaks, selling becomes difficult, spreads widen, rules change, taxes can change, and liquidity can vanish right when people need it most. The better outcome is repricing without disorder. Silver does not need the world to end in order to go higher. It only needs the market to recognize that real assets, tight supply, monetary doubt, and industrial demand are all pressing on the same small door. And when enough pressure builds behind a small door, you do not need a Hollywood ending. You just need the latch to move. So keep your head clear. Own what you understand. Do not confuse fear with strategy. Do not confuse a screen balance with direct control. And do not wait until everyone else is panicking to decide what you believe. Subscribe for more clear breakdowns like this and tell me in the comments, is silver moving because of industrial demand, monetary fear, or both? And one final thing. This is educational commentary, not personal financial advice. I'm giving you a framework to think through risk, liquidity, custody, and markets. Before making serious decisions with your money, slow down, check your own situation, and speak with a qualified professional who understands your goals, your timeline, and your risk tolerance.